Merely doing a bank reconciliation is not enough to identify misstatements in the cash account. You have to look at the controls over cash when you're looking at controls over cash receipts and cash disbursements. Other types of misstatements that are commonly that are common to the cash account would be duplicate payments. And again, this points to controls over the expenditure process or controls over the disbursement process. Again, you would want to see, and we'll talk about this when we talk about the expenditure cycle, is one common control an auditor expects to see when you walk in is that there's a match, what we call a three-way match. And a three-way match says for every cash disbursement that's made, or for cash disbursements, I expect to see that there is a corresponding purchase order, which is authorizing, the purchase order basically authorizes the disbursement, that there's a receiving report, that tells me that I received the goods, and so it's valid, right? I should be paying for it, and a vendor invoice, I've been billed for it. So to support that disbursement, those three documents should be included in a cash disbursement. They should match. And when those payments are made, the voucher package should be stamped, paid, some indication that it was paid to try to avoid duplicate payments or mitigate the chance of duplicate payments. So that, again, is a misstatement that you'll see. And the companies do have, we actually have some of our PhD students in AIS working on these types of projects where they're looking at how companies can control or mitigate duplicate payments. Because sometimes duplicate payments occur just because of the way information is entered into the accounting information system. So someone could enter in H.L. Brown, and somebody else might enter in H. Brown. It might show up in that company's vendor master file as two different vendors, when in fact it's the same vendor, which could cause sometimes duplicate payments. Improper payments of personal expenses. You see this when companies have, for example, they give their employees, say for instance their salespeople, credit cards, company credit cards. And or they give departments credit cards to purchase goods, right, just for that department. And you'll see that sometimes people will take advantage of that. So they'll go to, Target and they'll purchase their own goods, their own personal property on it, thinking, oh, I'll pay it back, right? But that's not the intention of a company card. Yes, Jimmy, did you have a question? P cards, yep. You have P cards and they're basically a credit card. Right? And so those, and you'll also see, and especially for employees who travel a lot, right? A company tries to mitigate, they don't want employees, you're traveling on business, they don't want a person to have to be responsible for any company or business expenses. That's not the case at Rutgers. I have to charge everything on my credit card and get reimbursed. But a lot of corporations don't want that, right? So they give their companies, their employees credit cards, and you're supposed to use those credit cards for business only. You're not supposed to use it for your own personal expenses. Even if you pay it back, you're not supposed to do that, and a lot of companies have strict policies against it. But it's harder to control, and so you do have employees who will use company cards for personal expenses, and sometimes those expenses are, a company ends up paying personal expenses as opposed to just business expenses. I'm not sure what happened here. Another thing is payment for raw materials not received. So again, this is where the receiving, when I talked about the three-way match, again, this is really important where before a disbursement is made, there's evidence that the goods related to that disbursement was received, and that helps to mitigate this misstatement. So again, auditors are going to look for those kinds of controls, and payment to employees for hours not worked. And again, if you look at these types of misstatements, so much of it relates back to the company's controls, internal controls over the process. Other types of misstatements which would normally be captured or discovered as a result of doing a bank reconciliation is whether or not there was a failure to include a check on the outstanding checklist, right? Because if you did not include that check on the outstanding checklist, if you issued a check, eventually it's going to clear the bank, right? And so you will see that as a reconciling item between the books and the bank statement. And then cash received by the client recorded in the wrong period. So let's say, for instance, the money was received at the end of December, but the client recorded it on the books and records as January. You'll see through the bank statement when that deposit was actually made, right? Because the bank is generally going to show the deposit on the date